Global markets continue to grapple with higher bond yields, sticky inflation and geopolitical uncertainty. The recent pullback in global markets reflected stretched positioning in a handful of technology-led stocks rather than a broad deterioration in economic fundamentals. While the long-term potential of AI remains compelling, the episode serves as a reminder that excessive concentration and elevated expectations can amplify market volatility when sentiment shifts. Encouragingly, the U.S. economy remains resilient, supported by healthy GDP growth and a robust labor market. However, inflation remains a key concern, with CPI staying above the Federal Reserve's 2% target for 62 consecutive months and recently approaching 4%, increasing the probability of a more hawkish policy stance in the coming months. The equity demand-supply dynamics in the U.S. are also changing. Support from corporate buybacks is gradually giving way to increased equity supply through large IPOs such as SpaceX, Anthropic and OpenAI etc. and secondary capital raises for CAPEX, which may pose as a near-term headwind. On the other hand, India is witnessing an increase in buyback after change in taxation while fresh issuances has been muted so far in FY27. India's real GDP grew by 7.8% in Q for FY27, supported by strong services sector performance, even as manufacturing momentum moderated due to the US-Iran conflict. With the GDP deflator staying subdued, nominal growth remained sub-10% despite healthy real expansion. Lower inflation has constrained nominal sales growth across sectors. However, a gradual pickup in inflation could support stronger top-line growth going forward. The key monitorable remains the ability of companies to protect margins and translate revenue growth into sustainable earnings growth. Persistent capital outflows have weighed on net FDI, leading to pressure on BOP and INR. Policy actions to contain dollar outflows and encourage inflows, such as hedging cost support for FCNR, B, deposit, tax exemption to FIIs for GSEC should help in stabilizing INR. Historical precedent is encouraging. Similar measures introduced during the 2013 taper tantrum helped attract nearly $35 billion of inflows and contributed to an 8 to 9% appreciation in the rupee. These initiatives should support currency stability and improve investor confidence over the coming months. Nifty EPS grew 5% year-on-year in FY26, extending the streak of single-digit earnings growth. While FY27 estimates have been trimmed, stable FY28 projections suggest the weakness is cyclical rather than structural. Meanwhile, mid and small caps continue to outperform on earnings, with the investment case remaining intact, underpinned by structural themes of formalization, digitalization, and India's investment cycle. Valuations on forward basis have become more reasonable compared to global peers as well as historical averages. Large cap, Nifty 50, is trading 1 SD, below 10-year average on 1-year forward PE basis. While mid and small caps still trade at a premium, excesses seen over the last 2 years have moderated significantly. The temperature gauge remains in the fair value zone. Overall, Indian equity markets appear to be in a base camp phase, consolidating after a strong climb, with valuations cooling and earnings catching up before the next potential leg of growth. The timing of this next phase will likely depend on the trajectory of global interest rates, geopolitical developments, and capital flows. We continue to maintain a neutral view on equities with an overweight on mid and small cap. Deployment can be lump sum in hybrid strategies, while staggered allocation is suggested for pure equity-oriented strategies. The MPC maintained the status quo, highlighting the RBI's balancing act between rising inflation risks and moderating growth. Recent measures such as FCNR, B, hedging cost support, for expansion, and FPI tax exemptions on government securities should strengthen capital inflows, reduce rupee volatility, and ease pressure for an immediate policy response. However, the possibility of future rate hikes remains firmly on the table if inflation risks intensify. Forex intervention by RBI and high credit growth led to tighter liquidity conditions and hence a sharp rise in short-term yields in the first half of this quarter. Liquidity situation, however, has started to improve this month. 10 years GSEC yield has softened by approximately 25 to 30 bps from the highs and is trading below 7%, due to fall in crude oil prices and policy measures to stabilize the currency. We expect yield to trade in the range with recent highs acting as resistance. In fixed income, we continue to suggest an accrual-focused strategy for both direct and managed products across the credit spectrum and income-generating assets. Gold continues to serve as an effective portfolio diversifier and currency hedge, providing protection amid geopolitical uncertainty and evolving global macro conditions. Silver's persistent supply deficit, rising industrial demand, and recent price correction make a strong case for investment. However, a measured allocation is warranted given its inherent volatility. We therefore continue to prefer gold as the core allocation within precious metals while maintaining selective exposure to silver.